Hello everyone, hope you guys are doing well today. So today we are going to bring to you section A of our pre-mock session. This is Afan Ahmed Mirza and I am a tutor of AA from Abil School of Accountancy. So today we are going to discuss each and every area of your section A that we can see, and we have as a pre-mock section B will be uploaded as well on our YouTube channel. So stay tuned and stay connected with the areas of queries that you have, and we have WhatsApp group as well for which the description link is given. So connect to that and discuss any of your queries. I'll be directly answering them to you. Okay, so let's begin. Now whenever you are reading a OTQ question, the first technique is basically just go and read the particular scenario. Before reading a scenario, read the question. If you're reading the scenario will give you the complete information of the 5 questions that we have. But sometimes the MTQ or the OTQ or the MCQ is basically just a general knowledge question. That is from your knowledge that you have studied from your particular areas. So let's begin. Let's read the first option question, that is, which two of the following initial action should Redridge and Go take following Northgate Company's refusal to allow Redridge Company to seek bank confirmation from Cedar Bank? Now they're refusing to basically take confirmation from the bank that they have accounts in. Let's read the passage. The area of bank and cash has been assessed as a high risk area due to large volume of transactions near the year end. So it is indicating us some kind of fishy movements. Northgate Company has various long outstanding accounts with 3 different bank institutions. During the year, a new account has been opened with a new institution, Cedar Bank. The management of Northgate Company has refused to grant Redridge Company permission to obtain confirmation letter from Cedar Bank. You are asked to assess what should we do if this is a scenario of problem. Now, this is a problematic scenario for us. This is a problematic scenario for us. Why? Because we are having errant transactions. We are not allowed to get confirmation from them. It could be due to some genuine reasons, but we are skeptical here. We will try to investigate whatever we can. Now, remember one thing, if we are not granted the permission to basically take a confirmation from the particular bank, it doesn't mean that we don't have evidence. We have other modes of evidence as well. So we are going to plan some other audit evidences, procedures that are going to help us in the longer run, that will help us in obtaining any kind of risks that we have and any kind of evidences that we can obtain. Now let's read the particular scenarios. Now, here, what does it say? The first option says send the bank confirmation request without management's permission. Now, if you're sending the particular bank confirmation without the client's permission, we are going to send it from our own letterhead. Yes, the client will not give his letterhead. That means basically we are sending him sending the bank a confirmation that they will not reply for. Why would they reply to me? Do they know me? No, they don't. If they don't know me, then they will not reply to my confirmation, because if they do, they will be leaking information that is confidential to a party that is not verified. So that will be a breach of law from their side, breach of confidentiality from their side. So this won't be the correct option that we are looking for. Next, re-evaluate the risk of material misstatement, including risk of fraud. This can be a possible answer. Why? Because we are having some transactions at the end, and the risk of this area is high, and we are denied the permission to basically conduct a confirmation as well. So this can be a risk of fraud, and risk of material misstatement can be assessed here. Next, revise the audit plan and consider alternative procedures. So alternative procedures should be performed so that we can obtain audit evidence. But let's read last point as well first. Issue a disclaimer of opinion as there is insufficient evidence available. Have you gone and looked to some other areas, other sources from which we can obtain audit evidence? No, we haven't. So how can we say that there is no available evidence for us? There is evidence, but we're not looking for it. So this can't be the possible correct answer. So this is incorrect, and 2 and 3 is the correct answer. I hope this is clear to you guys regarding the passage and regarding what actions should we take. In the exam as well, when you're writing the response of the auditor, or you're writing the response or affecting the audit report area, people directly go to the qualified opinion or adverse opinion or disclaimer of opinion. We know that you like these words, but use them very carefully, because these are not direct actions that we should take. These are actions that are last resort that we have. First, give the management an opportunity to basically rectify the errors that they have made. Now, next thing, which of the following procedures should be performed to confirm loan liability balances at the year end? So, loan liability balances at the year end are to be discussed here. Let's see. What is a loan liability? Data that we have. Not yet companies sourced external finance for the first time in the year. The draft financial statement show a current non-current liability in relation to loan finance of 1.2 million. So what do we have to verify here? Do we have to verify that there is a loan or not? No, we don't have to do that. We have to verify what is the balance at the year end. So balance at the year end will basically be a separate area that we have to test. Let's see what are the substantive procedures that we can perform in order to obtain confirmation that the balance at the year end is what is the liability that we have. Okay, let's see. Now, number one, what does it say? Review the board minutes for evidence of approval of external financing. Are we looking for authorization? Do we have a need for checking of authorization here? I don't think so. So this won't be a appropriate option. Next, agree the loan payment records in the general ledger to the bank statement to confirm capital has been repaid. So if capital has been repaid, basically, let's say I am saying I had taken ₹1,000 loan at the start of the year. I have paid out 600 from it. That means at the year end, I would be having a balance of 400. Would this basically calculate or help me identify the loan liability balance at the year end? It would, because this calculation, this numerical will help you identify what is the amount paid and what is the amount left. So this might be correct answer. Next, agree the year-end loan liability balance to the bank confirmation letter. So they're saying agree the year-end loan liability. Loan liability at the year-end should be compared to the bank confirmation letter. This will be a source of getting information what is the loan liability that is owed. But let's read the last option as well. Compare loan liabilities at the end of the year to balances in the previous year. So from previous year, we are comparing this year. Will it identify only significant differences, or will it verify what is the amount at the year end? Will identify differences, not verify what is the amount that is at the year end. So this is not a correct answer. So again, 2 and 3 is the correct options. So 2 and 3 is coming at option number 2. Now let's move forward. Okay. What does it say here? It says which of the following audit procedures provide evidence regarding accuracy, valuation, allocation of shares, capital presented in Northgate Company's financial statements as at 31st May 2005. Okay. Now let's say what the share capital is to do here. Northgate Company plans to expand its operation next year and has undertaken right issue in the current year to fund the new venture. Okay, let's see. What are the options that we have? Review the board minutes to identify matters relating to the share capital, including ensuring proper authority was given for the rights to be issued. Tell me one thing, am I asking for the permission or am I asking for the value of the shares that were issued, the accuracy of recording, and allocation of them in separately in the share premium and share capital? What is the entry? The entry is basically debit cash if we are issuing shares, credit share capital, and credit share premium. So if you are having a transaction and the transaction is recorded, the allocation should be in this way, right? So what should we do? We should basically go for just the transaction itself. No review would be done for the particular authorization of the share issue. So this is incorrect. Number two, agree the number of authorized shares disclosed in notes to the financial statements to Northgate Company's constitutional documents. So constitutional document will have authorized share capital, authorized number of shares. But does it identify the value of shares that I have? No, you don't. Does it identify that how have I recorded it? What does it? And where have I recorded it? It does not. So it is not an appropriate option for me. Cancelled off. Now we're left with the last two, so we can directly take them as well, but let's discuss logic for them as well. If some other option might be there, so why is it there? What is the thing that we have to see? Agree closing share capital balance in the trial balance to statutory records and the draft financial statement at the end. So I'm comparing the closing share capital with my draft financial statements and the statutory records. All are done by three-way verification. So will it identify me what is the amount that is recorded? Is it accurate? Is it complete? Is it allocated appropriately? and what is the value of the shares that we have. And next we have our inspection of bank ledger to identify what is the money received in terms of the exchange of shares. So the valuation, the accuracy of recording of records will be confirmed here, will be done here. So option 3 and 4 is the correct answer, and it comes at option number 4. So I believe it was clear to you guys how have we solved this question. Let's move forward. Let's see. Okay. Which two of the following substantive analytical procedures for wages and salaries are there? Now, if I don't read the case, I can identify which of the two are analytical procedures. What are analytical procedures? Analytical procedures have proof and total, comparison with last year or with budget. So here in we basically what we're trying to identify is we are basically having a logic test here in analytical procedures. If I don't read the case even, I can easily answer this question because I know what are analytical procedures and what are the other areas. So, but just for the assurance, let's read the passage. Payroll have been identified as a high risk area because it has frequent manual adjustments and complex calculations related to bonus and holiday pay accruals. So let's read them. Okay. Now recalculate. The first word gives me a test of details here. Test of detail is Cairo. Out of Cairo, only analytical procedure is not a test of details. So R is recalculation. Recalculation is a substantive procedure, not a substantive analytical procedure. So this one is incorrect. Next, compare the current year with the total of payroll expenses to the prior year. So comparison, is it analytical procedure? Yes, it is. Tick mark it. Then next, agree the total net pay per payroll records to bank transfer listing of payments to the bank ledger account. So they're saying that we are agreeing, we are verifying three documents. We are agreeing to each of the balances written in each of the areas. That is agreement, not analytical procedure. So wrong. And the last one by the name of it as perform proof and total and compare expected payroll expenses to actual is an analytical procedure that we have. I believe this was very easy for you guys as you are well versed with the analytical procedures as well. Now let's move forward. Okay. Now here, which of the following procedures would not test understatement? They would not test the understatement of bonus accrual in not-good companies' financial statements position. Okay, let's read it. Is there anything regarding accruals? Yes, there is. There are calculations related to bonus and holiday pay accruals. So we are basically trying to identify what is the area that is not going to identify understatements. Let's see which are not going to identify. So the easiest way is to check which of the procedures will identify the understatements, cross them out. So let's see. Here what we can see is agree the payment of bonus from post year end statements to the accrual listings. So if I'm verifying, if I'm paying some amount, if I'm say paying some amount from the bank and I have a accrual listing there, so will it verify that I have paid the amount that is in the accrual listing? Yes, it will. So this will not be recorded. If I'm paying the amount that is higher than the recorded accruals, that means my accrual is understated. So here it is. Next, agree the bonus from the payroll records to the accrual listing. Agree the bonus from the payroll records to the accrual listing. Accrual listing will give me the list of accruals. The total bonus, if compared with it, can it identify the understatements? So incorrect. Next, compare the accrual budget and prior year and investigate significant differences. If you are investigating differences from the accrual of this year to the last year, it will basically identify a significant difference and that will be understatement. That is the same area. Leaves it with me number 4. Number 4 says select a sample of employees from bonus listing and recalculate their bonus. That is the correct answer. So I believe this was clear as well. Let's move forward to our next area. Now, with this, we have solved our first question of the particular area of your MTQs. So, anyone having any queries is welcomed right now. Okay, let's move towards our case number two. Now, case number two says the same pattern is to be followed. First, read the question, then go for your case, and then we'll solve it. Which two of the following corporate governance principles should Acme company comply with? Okay, let's see. Now, let's read the case first. Acme company is given Burrow and Co has audited Acme company for the last 7 years. The board has decided that Acme company will be listed on a stock exchange within the next 4 years. So they are going for a listing. So that means they have to have a very keen structure of the board. And I has asked Burrow and company to advise how to achieve compliance with corporate governance principles. The board is also considering establishing an internal audit function and has suggested that they may wish to outsource it to Burrow company. Okay, let's read. Now, the second part is irrelevant to us. The first part is relevant. Now, first of all, they're saying the remuneration committee should be composed of independent non-executive directors. So that is very true because executive or remuneration committee will basically be deciding the remuneration of the executive directors and the higher management of the company. So obviously, if we are having independent people here, we will have a higher level of reliance that yes, the salary is based on co and fair grounds, not on any kind of biases. Okay, so if no biases are there, that means basically we can rely that yes, everything is correct and we are having no kind of differences available. Okay, so this should be adopted according to me. Yes, it should. So let's tick mark it. Next, the chief executive officer should be responsible for the leadership of the board and ensuring its effectiveness. So tell me one thing. If I'm telling you that the person running the company is going to make the decisions for the shareholder as well, he's going to represent the shareholder as well. That's not true. That should be not be done because he is getting excessive power in his domain in his hands. It will be difficult for him to basically get the total outcome of the results that we want. The board is there to ensure that the management is not overriding their duties or not overriding or overtaking or overdoing their duties or taking something that is the right full ownership of the shareholders. So if the people who are basically working on the money of the shareholders are managing the decisions that they are going to take for the shareholders as well are the same persons, and it will be difficult for us. Now let's see. The CEO is the executive parties. Executive party will say that we want more remuneration. Yes, they want more salaries. If he is made the chairman of the board, will he raise this agenda and force everyone to basically comply with it? Yes, it will. Is it in the best interest of shareholders? That doesn't matter. That doesn't matter here because the party is looking at their agenda here. So the thing should matter that whether it is in the best interest of the shareholder or not. So this option is incorrect. That is a strict no-no for us. And if you find this in any scenario, highlight this as a key significant risk because one person is having a complete total power, no segregation of duties is there. That will result in a very negative outcome. Okay. Next, the non-executive director should provide constructive challenges to and strategy guidance. Yes, they should. A strategic guidance is basically a guidance on what to do and what not to do, provide some insights on the strategies that we have developed. So positive criticism is well invited and well welcomed in an organization so that they can increase the chances of having profits and the wealth of the shareholders. So this is a correct answer. Let's read the last one as well. Audit committee should approve and appoint the external auditor. The approval and appointment of external auditor is in the domain of the shareholder, not the audit committee. The audit committee is to make sure that everything runs smoothly. They present the options to the shareholder, but the appointment is done by the shareholders only. So this is a wrong answer, leaving us with option number 3. Let's move forward. Number 2. Now, what does it say? It says that which of the following factors must be considered before Burrow and Co. can accept Acme Company's international audit engagement. Okay. Now, which of the following factors must consider before Burrow Company can accept Acme Company's internal audit engagement? Let's see. They are basically being asked to set up an internal audit department. Now, whether the external audit team has the expertise to carry out internal audit work. So tell me one thing: if we are basically uh, taking the responsibility of internal audit department, should the external audit team take it? I don't think so. External audit team should have no link with it, because if they are linking with it, they will have a self-review threat here, because we are testing of controls. We are testing controls. If you're testing control and we are the one designing it, it will basically result in a self-interest threat or self-review threat. Sorry. So it won't be the correct option. Next, if the assignment will relate to internal controls over financial reporting, this is a thing that we should consider. Obviously, we should consider this. Why? Because this will basically result in a self-review threat, as we are just discussed. So we have to make sure that this is not significant. And then, if management will accept responsibility of implementing appropriate recommendations, if they are not accepting a responsibility of implementing appropriate recommendations, then why are they hiring us? Why are they making the department? So they have to take the responsibility of implementing the particular controls in the company, so that we are staying independent and our advice is valued. We are valued in the company. So yes, this should be the correct answer. So 2 and 3 is the correct answer. Option number 3. Let's move forward. Number 8. Okay. Which of the following would result in Burrow & Co. assuming a management responsibility in relation to internal audit services? What? Which of the following would result in Burrow Company assuming the responsibility as internal audit department services? Okay, let's see. Now, internal audit department services are well identified here. Okay. Now, what is the area? Now, first of all, taking responsibility for designing and maintaining internal control systems. Is this the responsibility of the management? It is. Is it the responsibility of the management? Yes, it is. So if we are taking the responsibility of designing and maintaining control, designing and implementing the control or maintaining the control, are we assuming the responsibility of the management? Yes, we are. This is the correct answer. They are asking us which will result in a management representation or management responsibility taken under by the auditor. So management is performing responsibilities that the auditor is performing responsibilities that the management should do. So that will result in this. Now, determining whether the work of the internal audit function can be used to obtain audit evidence. So this is the duty of the auditor, not the management. To determine whether we can use the work of the internal auditor, the duty is with the external auditor. So this won't be the correct option. Leaves us with number 3, that says us that setting the scope of the internal audit work to be carried out. So scope of the work to be carried out is decided by the management. Okay, so this will be your correct answer. So 1 and 3 is correct. That means option number 3 is correct. Okay. Now look, the main key to success in these questions are just reading the question very carefully. The passage won't give you a lot of information, but it will give slight information that can help you in basically determining what to do and what not to do. Okay, so your knowledge regarding the ISAs, regarding the cases are important here. So I always urge every student, please study audit as a practical subject. Try to implement cases, try to solve cases, try to study cases before you are attempting exam. So my teaching method also focuses on that. That in each of the areas, even substantive procedure, audit risk, I have highlighted scenarios and what should we do in this scenario. That helps us immensely in application fields that we are weak for. Okay, now let's read what the question has to say for us. Which of the following is an adequate safeguard against threat created by fee from Audit company? So let's see what Audit company has done with us. Now here Audit company is a listed computer software company. Burrow Company has identified that the fee from Audit company for audit and other services will represent 16% of Burrow Company's total fee income this year, compared with 15.5% in the prior year. So we have a threshold that we cannot exceed the services, we cannot give services for which we are receiving more than 15% of the complete fee per year from a single client, because it results in self-interest rate. So here we are having two consecutive year. If the next year we have this particular 15% above fee, it will be a problematic situation for us. Okay. So the audit engagement partner has asked you to consider a safeguard for this self-interest threat. Okay, they have given you threat as well. Let's read the options. Now, what do they say? First of all, Disclosure to the firm's ethical partner that fee from Audit company represents more than 15% of Burrow and company's total fee income. So disclosure is important. Disclosure is important, but it is not a safeguard that is complete. It is a safeguard, but not complete safeguard. What good would it do by just disclosing it if I'm not taking any relevant actions? So I would take relevant actions as well. So the first option won't be correct. Okay, next move forward. Let's read all the options first and consider which one is incorrect, then we'll go for the correct one. The pre-issuance review equivalent to an engagement quality review. So pre-issuance review is a good safeguard, is a good control that we can apply in order to obtain audit evidence that yes, we are independent enough. This fee has not hindered us through a self-independent, self-interest threat. This is a good option, but let's read the other one as well. Using professionals who are not audit team members of to perform non-audit service. So if we are basically hiring or basically using another team on the audit firm to basically perform the particular task in the client company, but the fee is coming to the same company, so self-interest threat will be there. So this is not an elimination of self-interest threat. Next, post-issuance review by the engagement partner of audit company. So once we have issued a report, what is the need for review? What good would it do? It would not deter or it would not hinder the people from having a self-interest threat. So post-issuance is a useless thing for us at this stage. Okay. And so last thing, pre-issuance review. Pre-issuance review will basically act as a defense against people will be scared of it. It will defend against self-interest threat, and people will know that we are going to be checked, so they will try to be true and fair in all terms. Okay. Now let's move forward. Okay. Now the last case of last question of case number 2. What does it say? Indicate by clicking on the relevant boxes in the table below whether each of the following statements regarding the provision of assistance of Elmer companies true or false. Okay, what is the area that we are given? Elmer company is a listed company, is a national distributor of cleaning products. The management is planning to develop a new website, offer online sales to its customer. Elmer company finance director has asked if Burrow company can provide assistance with design and implementation of website. So this is a huge risk that they're doing. They're basically trying to take us in a position where we are assuming the responsibility of the management. So this is a very problematic scenario for us. Let's read the case. What are they saying? Now, a familiarity threat arises as the new systems will produce data which will be used directly in the preparation of financial statements. Familiarity threat is not a threat that is stated. Familiarity threat is that we know the shareholders or the people of the company too well that we will highlight their deficiencies or problems in the audit. So this is a false statement. Next, there is a risk that Burrow company may assume management responsibility if they become involved in making these decisions. Yes, this is true. Next, there will be a heightened self-review threat that due to the auditor's reliance on controls, testing, and on analytical review of the data summaries generated by the Newman systems. So there is a heightened self-review threat. The self-review threat has increased because we are going to use the data that is coming from the website, obviously from for the audit, and it will increase the chances of having errors, and we are not going to highlight them. So this is true as well. Moving on towards the last area says the Burrow and Co should use a separate team made up of non-audit staff to conduct the work, and the work performed by this team would be subject to independent professional review. So if they are basically done by separate team as well, in the end, the data is coming towards us, and the data is so wide that it cannot be avoided. That we cannot avoid that data. So this will result in a self-review threat. This is not a safeguard that we can apply. So with this, we have done case number 2 as well. I believe that this was clear to each and every one of you. You don't have any queries here. If you have any queries, please point them out right now so that we can discuss them and move forward to case number 3. Okay, let's go for the last case that we have. Okay, what does it say? ISA 560 subsequent event requires auditors to perform audit procedures to identify subsequent events. The period covered by this review for marine company commenced on 1st April 2005. Which of the following date is in the and is the end of period covered by subsequent events review? This is a trap for you. Very honestly speaking, this is a very big trap for you guys, because the duty of the auditor doesn't end until unless they are out of the organization. Okay, the duty is divided between active and passive. Okay, when you look at the particular scenario, they are giving you the active duty. They are asking for the active duty here. Now, normally the active duty is till the date when the audit report is signed. Okay. After that, we have a passive duty. The duty does not end there. The active duty ends there, but this passive duty starts there. That if we find anything after the date of audit report that comes to our attention that we require, if we would have known earlier, we would have changed the audit report and made the financial statements amended. Then this would have been done. So we would have done that. We would have considered that subsequent event as well. But that is a passive duty. So I have not read the case. I don't need to read the case, because this is a knowledge based question completely. So in this scenario, I will just identify. I will go for the area where the audit report will be signed. So option number 3, I believe, says so. So this is the correct answer. Now reading other options will confuse you, because at the back of my mind, I am very clear that the active duty is till the audit report is signed. So just quickly, don't waste time when you have a clear option. When you have no doubt that this option will be wrong, just go for it. But if it relates to a scenario, then you can go for it, because I've read the scenario. I know that there is no kind of indication there. Now, what do they tell us? They are asking us in the question number 2 that indicate by clicking relevant boxes that table below whether event 1 and 2 will be classified as adjusting or non-adjusting event according to IS 10. Okay, let's see. Case number 1 says the springs in a new type of mattress has been found to be defective, making the mattress unsafe for use. There have been no sales for this mattress. It was due to be marketed in the next few weeks. It is not marketed, it is not sold. That means there is no legal claim in this area. The company insurers estimate that the inventory that was valued at 750,000. So cost is, let me write it down. So the cost that we have identified is 750,000. Okay, has been affected. The insurer has estimated that the mattress are now only worth 225,000. That means there is a substantial decrease in the value. So the value, the NRV, we can say, is 225,000 now. So the fall in the value is approximately 525,000. Okay. Now, there has been no claims against the supplier of spring company, as this company is in liquidation with no prospect of amounts being paid to the third parties. There is no amount to be paid. So we are sure about that. The insurers will now not pay marine company for the fall in the value inventory, as it was underinsured. All the inventory was in finished goods store at the end of the year, and no movement have been made. That means no sale are there. So at the end of the year, does this condition exist that the value has decreased? Yes, it has a condition here. So it is an adjusting event. Now, number 2. Event number 2. Production at the factory was halted for 1 day, and the truck carrying dye used in coloring the fabric on mattresses reversed into a metal pylon, the puncturing the vehicle, allowing dye to spread across the factory premises into a local river. The environmental agency is currently considering whether the release of dye was in breach of environmental legislations. So first of all, it is a very conceptual thing that getting a vehicle punctured and spilling off something is not a thing that we would have planned. Obviously, it is not a thing that we would have planned. So if we would have not planned it, obviously it is not an existing event. We don't have any condition that after we don't have an intuition that it will be a just non it will be an event that will happen after the year end, that we are going to spill the particular dyes in the river. So it is not a thing that we would have anticipated. So this will be a non-existing event. Okay, now moving forward to question number 3. The last one is going pretty smoothly and pretty fast. Okay. Now they are asking us indicate by clicking on the relevant boxes whether each of the actions following the audit procedures are valid or not in relation to event number 1. We have rent, Event number one, let's see the particular substantive procedures. So obtain confirmation from the insurer of amount recoverable under the policy. So yes, this will be a valid option because it is going to verify me or identify me the NRV of the inventory. That is important. Now, inspect correspondence with supplier concerning with their solvency. So yes, it is important because we can't make a claim with other parties. If we are recording an asset that we will get money, we need correspondence from the supplier. So this is a valid substantive procedure. Next, recalculate the net realizable value estimate for the inventory. Yes, recalculation is important for us so that we can record it at according to IS2 or at a lower of cost or NRV. This is valid. Then review post-errand physical inventory counts of matrices. So they have clearly told us that there is no movement in inventory. So why are we counting it? It has nothing to do with it. So it is not valid. And inspect subsequent cash receipt from sale of defective inventory. We have not sold anything. They have clearly told us that as well. That we have not sold anything. There is no thing such as happening in the company that is going to move the inventory from the warehouse. If there is no movement, that means there is going to be no sale or receipt of cash as well. So that is an invalid procedure as well. I believe this was clear to each and every one of you. Why have we chosen the option that we have chosen? Okay, let's move forward to our second last question. Okay, now here what does it say? It says that which of the following audit procedure should be carried out on event number two. So event number two is non-existing event. So let's see what are the things that we can do. First of all, inquire of directors whether they will recognize the provision for a fine in the financial statement. Tell me one thing. Is there an estimate of the particular extent of damage that we have? No, we don't. Has a claim come towards us? It hasn't. So how can we record a provision or discuss it over the provision that we should record a provision for it? We can't record a provision when we don't have an estimate, we don't have a condition there, we don't have a probability that we are going to face a case. So the first option is incorrect. Okay. Now number two, obtain board minutes to determine the extent of damage. Yes, we can do that. We can do that where we can discuss what is the extent of damage that we have caused to the river and towards our company as well. So we will discuss that obviously. But we cannot record a provision obviously because we don't have the estimated numbers. Inspect the environmental legislation and any interim reports from the environmental agency to determine extent of damage. So if there is any laws regulation, will it help me identifying the provision whether we can record it or not? There can be legal claim in the future. So we have to be ready or made ready about that, and we have to give a disclosure in the financial statements that there might be contingent liability for us waiting in the future. So yes, 2 and 3 is the correct option. So we will be choosing our option number 3 here. Okay, moving forward to our last OTQ. Okay, that says now they have given us a passage. Now they're saying that the auditor was signed. The auditor report was signed on planned date. The unmodified opinion was issued. Okay, it is now 20 July 2005. The annual general meeting is to take place on 21st August 2005. The environmental agency has reported and has issued a report stating that the marine company is in breach of environmental legislations of 900,000 will now be levied on the company. The amount is material to financial statements. Which of the following audit procedure should be performed in respect of these fines? Now we have to identify what would be the substantive procedure that we have to perform. Okay, let's see. Discuss the matter with the directors to determine their course of action. Now, I have misread the case and deliberately done that. I wanted to see whether you guys went for it or not. They have told you that which of the following audit procedures should not be performed, not be performed. That's why reading the case is very important because my 3 answers would have been correct here. That I would have gone for, and I would have been confused to my life that what should I do next. Now, what you have to identify is that every correct answer is the answer that is not going to basically be performed as a substantive procedure regarding the fine. So identify what is a substantive procedure that should be performed and cross that out. So first of all, first one is saying that discuss the matter with the directors to determine the course of action. We would do that. So this is an incorrect answer. Okay. Determine whether the financial statements need amendment. It would be a possible option. Yes, it will be. So we would not do that as well. If directors amend the disclosure in the financial statements, an emphasis on matter paragraph in the existing auditor's report will be added. Emphasis on matter paragraph would not be basically added, because here we have a non-existing event. Non-existing event is not there in the particular financial statement in the dot is here. So we are not going to basically do this. We are going to basically redate the report. The auditor's report will not change. The auditor will basically redraft and redate the particular areas. Okay, the emphasis of matter paragraph won't be added here. So option 3 is the correct answer, but let's read the option 4 as well. If the director decide not to amend the disclosure in the financial statements, speak at the annual general meeting to inform the members of the facts. So informing them in the AGM would be a proper aspect that we would do. See, what would we not do? We would not basically. Okay, I've mismarked it. The last one is the incorrect one. Option number 3 is the correct one. We would basically not add emphasis of matter paragraph and make the financial statements be amended, because this is a non-existing event. Okay, so with this we have completed our section A of our pre-mock. I believe that everything is clear to you guys. If anything is there that you find difficult or you need assistance in, our WhatsApp group is there, as I discussed earlier as well. So connect to that and discuss anything you want with me, and I'll surely answer you for it. So have a very successful exam attempt. I hope you guys pass with flying colors. So we'll meet again in the future, inshallah. Till then, enjoy learning.